Hey Californians, Uncle Doug here, a native son myself, born and raised in Thousand Oaks, California. Grew up surfing Malibu and Ventura and tuna chasing down in San Diego, lived in San Diego as well. Look, of the 550 cities in the United States that have the average sales price over $1 million, 40% of them are in California. So there's a huge population of you folks that have jumbo loans. And right now, I just heard a guy that closed a year ago at 8% on a jumbo loan at like $3 million. I couldn't imagine what that payment looks like. But let me tell you this, or let me ask you this. If I could get you a comparison effective APR loan in the 1s, 2s, and 3s, for those who qualify, and not everyone's going to qualify, but if I could get you a comparison effective APR in the 1s, 2s, or 3s, would that be worth paying attention? I'm not saying I can, but let's find out if I can. All right? And I want to show you, first of all, why the 30-year amortizing loan is just such bad medicine. This is the amortization chart of a 30-year amortizing loan. You'll notice that at month 222 is when you finally start paying more principal than interest. Until that time, you're paying more interest. This is the sweet spot for the banks. They love it when you refinance every 5 or 6 years. They'll encourage you to do it. Why? Even if the rate's dropping. Why? Because it sets the sweet spot all over again, and they stay in the sweet spot here, which is their profits, right? You must really love your bank if you are using this loan and you now know about the Home Select product from Geneva. We are the only correspondent bank in the United States with a Home Select product. This product was brought to the United States roughly 20 years ago, just shy of 20 years ago. Sir Richard Branson of Virgin Records, Virgin Atlantic, Virgin Everything, was one of the guys that is instrumental, is my understanding, for bringing it over. And it was originally the rarefied air, the rarefied mortgage for high net worth individuals who were clients of AIG, Merrill Lynch, and Ameriprise. Now, after the meltdown of 2010, those guys all got out of the mortgage game, and here we are. So Geneva is the only that I'm aware of correspondent bank, and especially the only bank with the Home Select product specifically, because that is our product. Let me show you. We're going to walk you through real quick just a scenario. So we're going to assume that we're looking at a rate and term refinance. Let's say you've got a $4 million house with a $3 million balance. Let's say, I was going to say 599, but we'll go crazy low. We'll say 575. Now, right now, jumbo rates are somewhere between 6 and 6.5 for most borrowers. So I'm lowballing this for you guys to show you just how powerful this is. And I'm comparing it to a rate that's probably not even available to you right now. Okay? But that's how confident I am in this product. Now, the next thing is I'm going to say that, okay, a borrower that lives in a $4 million house with a $3 million mortgage probably is depositing somewhere between 15 and 25, 30, 40, who knows how much a month. I have to pick a number here. Each scenario is different. Reach out to me with your scenario. Let's talk. But let's assume that this borrower has 20 grand a week going into their checking account. Okay, this is, if you're self-employed, it's whatever money you're throwing in your checking account. If you're a W-2 employee, this is post-tax, post-insurance, health insurance is probably taken out, and post-401k or retirement accounts. Okay? And then we're going to I have to estimate how much money are you saving at the end of the month. And again, everyone's different and it varies, I know. So let's say that you're paying your house payment here and you're blowing through another 35 grand in private school for your kids. Maybe one of the kids has a horse. Maybe you guys have 3 or 4 cars, the SUV, the crossover, maybe the sports car in the garage as well. You're spending money aside for travel. Maybe you're taking care of your parents as well. But let's say you're still saving $30,000 a month, roughly 35% of your net income. And then we just tell the algorithm to do its thing. And there you go. So would you be pissed if I could get your house paid off in 7.1 years? You still have access to all the money we're putting into this event, into this vehicle. It's a first position HELOC tied to an FDIC insured checking account. So on the back end, you don't do anything different on the front end. On the back end, we have some heavy duty tech floating around there to make this happen, because this is designed to get your mortgage paid off as quickly as possible and to shelter you from as much interest expense as possible. So in 7.1 years, now we've gone down the road 7 years. It was a $4 million house. Now it's worth what? Maybe $5, $6, $7 million free and clear. Your house is free and clear. You've got a $3 million line of credit free and clear. I've saved you $2.3 million in interest expense. $2.3 million. Are you picking up what I'm putting down? This thing is crazy. Now, most people are like, oh gosh, I'd love to get a 6% rate or a 5%. I think we put 5.75 in the initial, right? How does this sound to you? How does a 2% comparison loan effective APR sound to you? 2%. It's not too good to be true. It's just a different type of finance. You have to unlearn what you think you know about mortgages. The 30-year amortizing loan is a very old school mortgage. It was designed, it's pre-boomer. It's not even okay boomer. It's pre-boomer. It's silent generation stuff that was designed to help people buy homes after the Great Depression. They had no money. And the reason all these loans are now 30 years is because when the 30-year amortizing loan was devised, people usually only lived to 60. Now we're living to 80 and 90 and 100. My grandmother lived with me to 107. So 30 year is just old school, and why finance that debt that long if you can get out of it and then utilize that money for other wealth building stuff? So I'm going to give you a quick example. First of all, let me show you the pay down graph. Look what happens in just 2 years on this loan. Not only do you already have $1 million in equity, you've just generated another $700,000 in equity versus a 30-year amortizing loan of $80,000. And keep in mind, this is your money. It's available on a line of credit, which means you can write a check against this to go buy that Ferrari, to go take that vacation. If you want to take a year off, you know what happens? Your balance just goes up. Reported paid as agreed. This is truly turns your house and the liability associated with it into a tool, because I don't care how good of a boy or girl you are, and if you're prepaying down your mortgage, you know what happens if you get laid off and you call your lender? They say, Bob, Lisa, that's terrible. We feel badly for you. Make your payment. Ooh, you're sick? You're fighting cancer? That sounds horrific. Make your payment. They might give you 3 months off, maybe. But you have to beg. You are living for your house. This turns your house into a tool for you to utilize as you see fit. So let me go back and show you this little tidbit, and then we'll call it a day. We're at 8 minutes already. So you already assumed that you were going to be paying down, let's say you were going to be paying down 30 years, right? So maybe you're in your 40s, you figured you're going to pay off this house at 70 and retire, okay? So now, since you aren't doing that anymore, you no longer need to pay off the house because it's paid off in only 7 years, 86 months. We'll just assume that you're still cool with taking that money for the next, what is it, 360, so next 280, 270 some odd years, and you're just going to apply it towards investments. And let's say your house is going to appreciate at 4%, and your investments are going to go up at 7.5%. And now look what happens. So if you just kept in your house at a 4% appreciation, congratulations, you got a $13 million house. Pretty great. Utilizing this loan, you now have a $26 million net worth because you still have the same $13 million house, and you've also grown another $13 million in investments. Now, if that does not get your juices flowing, you must be dead or something else is going on that I'm not aware of, because this thing is crazy. Reach out to me. Let me walk you through your own personal scenario. Like I said, everyone's is different. We have people that are using this as a reverse mortgage, so they'll work, pay off the house, and then if they never need any money, they can just draw right against the house. They don't have to qualify anymore. We have people that utilize this to pay for kids' college funds. The only reason people refinance this house is to get a bigger line. We can go to 90% on a jumbo loan with only 10% down and upfront MI. At 80%, there's no MI. Realtors, if you're selling jumbo houses, this is the only loan I would be pitching. And beyond that, clients will remember you because this is a game-changing, life-changing loan as compared to a 30-year mortgage. Uncle Doug, drop of knowledge. Have a great day. Be the change you want to see in the world. Reach out. I can help.